My name is John Paul Ruiz, the Director of Professional Development here at the Entrust Group. And again, welcome to the national webinar entitled How to Use Your IRA to Buy Your Future Retirement Home. Again, my name is John Paul Ruiz, Director of Professional Development here at the Entrust Group. Just a little bit about myself before we get started. I do hold the QKA designation through the American Society of Pension Professionals and Actuaries, as well as the creator of the IRA Academy, which is the preparatory course that financial institutions use to acquire the CISP designation, a Certified IRA Services Professional designation through the American Banking Association. Enough of myself. Let's begin the seminar. But before we get started, we just want to let you know that this particular seminar brought to you by the Entrust Group does not provide investment advice nor endorse any products. All the information materials are purely for educational purposes only. So if there are any questions specifically asked about a particular situation, keep in mind our answers will come purely from a broad general perspective and not address an individual's question from a tax perspective. All parties are always highly encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment. Keep in mind, as we go through the seminar, not only do we encourage you to involve your tax advisors as well as legal advisors, but I will also try to give you some resources where you could read so that you could educate yourself in regards to the information that's being provided and actually verify that with the materials that may be provided by the Internal Revenue Service and so on. We at the Entrust Group do not even mind having conversations with your legal advisor as well as tax consultants to be able to answer general questions about retirement plans so that you can make an informed decision before you proceed forward. Again, we do not offer tax advice since we are not licensed to do that, but we do offer educational material, general educational material to give our clients enough information to get started. Now, who is the Entrust Group? The Entrust Group has been around for 35 years. We focus mainly on alternative investments, although we do have platforms that you can avail of that could possibly have mutual funds, stocks, bonds, but primarily our niche is in the alternative investment world for retirement plans. In other words, if you have retirement plan assets above and beyond stocks, bonds, mutual funds, our niche is to be able to offer the citizens of the United States a means of investing their retirement plan assets in other types of investments beyond what is typically offered through banks and broker-dealers. Self-directed retirement plans have taken on a connotation that you are investing in alternative investments, but for the most part, most IRAs out there and retirement plans are self-directed. In other words, the IRA holder directs the custodian on where to invest the assets. But in the self-directed retirement world, there are provocative questions that must be asked by the taxpayer before proceeding, and a lot of those may not be answered by the Entrust Group, and that's why we highly advocate for you as a listener of this, if you are an IRA holder, to involve your tax consultant or tax advisor as well as your legal advisor before entering into a particular investment, because that goes beyond the scope of what we provide as an administrator of self-directed retirement plans. We process quite a few transactions on a yearly basis for all of our clients because some of the transactions that we transact under an individual's IRA goes beyond the normal day-to-day workflow of other financial institutions such as banks and broker-dealers. We deal with investments such as real estate, which is the topic of this particular course today. We also have precious metals as well as other types of alternative investments that are allowed under a retirement plan. We do hold over $2.2 billion of investors' assets. In other words, the value of the investments that they hold under our financial institution or our financial organization is over $2.2 billion when it comes to investors' assets. Our staff, we try to educate our staff as best as we can in regards to the inner workings of, number one, retirement plans, as well as other topics to be able to have meaningful conversations with our clients. Our staff most of our staff holds what we call the CISP designation, and that's why I wrote the school called the IRA Academy, approved by the American Banking Association, as a preparatory course for the Certified IRA Service Professional designation. Is to make sure that our staff knows enough so that, number one, they would know what type of questions they can answer, as well as, number two, know when to refer you to your tax advisor or legal advisor. We do have national brick-and-mortar offices in certain parts of the country, as well as we do offer national CE programs for other designations for some of the presentations that we present, such as the CFP board, NAS, BA, as well as for other practitioners such as CPAs. They can possibly use some of our courses as continuing education material. We do hold national webinars such as this one, whether it be in a webinar form, or in some cases, sometimes if there's enough people, we can hold it locally in person at certain parts of the country where our business development associates may be available, or I personally could fly out somewhere if there's enough of an audience that are of interest. All right, let's begin with the webinar. The agenda is we're going to talk about the background of why this particular webinar came about, and what birthed the interest in this particular webinar, and mostly what birthed us creating a particular webinar to answer people's questions. I'm going to let the cat out of the bag. We get asked all the time, can you use your IRA to build wealth for your retirement home? And some of the those questions are what we're going to try to answer in today's seminar. What's the difference between a traditional IRA versus a Roth IRA? If you want to use your retirement plan assets to build wealth towards your retirement home, there is a big difference on whether or not you build it through what we call a traditional IRA versus a Roth IRA. We're also going to talk about this topic called prohibited transactions. Given the fact that in an IRA, an individual cannot benefit out of the investment held while it's in the IRA, we need to understand what prohibited transactions are. We're also going to take a look at a case study in regards to a simplistic case study on how to use your IRA now to buy your future retirement home. Last but not least, we'll summarize everything that we've talked about, and then we'll open up the phone lines for a question and answer session. This telephone webinar is intended to last approximately an hour long, and depending upon how fast or quickly we go through the material, we'll spend about 30 minutes to 40 minutes on the presentation, and then we will open up the lines for any questions you may have. I already have a list of about 3 questions that people have already brought up. We will try to hit those questions as quickly as we can and as precisely as we can, and answer them as precisely as we can. And I'll be honest with you, whether or not I can answer that question for you or refer you to your tax advisor. But for the most part, a lot of the questions that have been asked so far are something that we can address in this particular seminar. Now, what is the background behind this particular seminar? We get asked all the time, can you invest in real estate using retirement plan assets? And the answer is yes. There are only four investments that are strictly prohibited under an IRA. 1 are your collectibles. Number 2 is the life insurance contract. We're not talking about annuities here. We're talking about a life insurance contract that has an endowment provision. What it means is that at a certain point in time, people wanted to put a life insurance contract that, if you pay a small premium, if you die, in other words, it's incidental to death, a certain dollar figure will go into your IRA. Wouldn't that be a great racket? The IRS says you can't have that. So again, collectibles and life insurance contracts. Another type of investment that you cannot hold under an IRA, what we call S-Corps. S-Corp, given the fact that an IRA is a valid trust under state law, trust cannot be a shareholder of an S-Corp. Therefore, a revenue ruling was issued in 1992, issued by the tax court, by the Internal Revenue Service, which is under the Treasury Department. It says an S-Corp cannot be an IRA cannot be a shareholder of an S-Corp. Therefore, S-Corps are prohibited investments under an IRA. And then lastly, common collective funds that are not registered under the Securities and Exchange Commission may be prohibited from investing in an IRA. an IRA may be prohibited in investing in a common collective fund under an IRA. But for the most part, anything could be an investment held in an IRA. Now, from a strategy perspective, I get asked all the time, can they use the real estate owned by their IRA as a retirement home? In other words, can I personally purchase the real estate owned by my IRA? In other words, if you have a piece of real estate held by your IRA, can I purchase that from the IRA if I want to use that as a retirement home? Those are the types of issues that we're going to try to cover in today's webinar. And another question is, how do I get the real estate owned by my IRA to my name? In other words, how do I take out that piece of real estate? And lastly, what are the tax implications in regards to that? And that's where understanding the difference between a traditional and a Roth IRA comes into play. If we understand the rules and we draw and color within the lines of the law, there are some, strategies that could come about, of course, with the help of your tax advisor, because I personally do not know what your tax situation is, nor do I want to know. But that is something that you could work with your tax advisor in regards to, if I distribute this asset from my IRA, which is a taxable account, how much tax will I have to pay? That's a magical $2 million question that a lot of people ask. Is because, number one, I don't know how much is in the IRA, and I don't know what your tax situation is. And number two, I don't know when you're going to do it. The reason why that's important right now is because the way we get taxed today may change the way we get taxed next year. As an example, we're coming into an election season. There are people running for office that are saying, we're going to reduce taxation. There's another one that says we're going to increase taxation. That depending upon your marginal tax rate will determine how much your assets will be taxed when you take a distribution out of a taxable account. That's why it's very important to determine which one is taxable and which one is not taxable. We're going to cover the difference between the traditional IRA versus the Roth IRA. Now, when it comes to your IRAs must be funded in order for you to be able to have enough cash in there to be able to purchase an asset. So we're going to cover first how are these retirement plans, individual retirement accounts, traditional versus Roth, funded. In other words, what monies come into these particular accounts so that we can determine where the money is going to come from to purchase the piece of real estate, as an example in this particular webinar. You keep in mind, you can't just dump whatever amount in your retirement plan and purchase it under the retirement plan. There are limits on what can be contributed, and also there are rules in regards to where does the money come from that funds these particular individual retirement accounts that you hold under a custodian. Let's first take a look at a traditional IRA. And, of course, the obvious amounts that can be used to fund the IRA are your annual contributions. They're pretty small amounts, but it is still a source of funding an IRA. It's $5,500 with an additional $1,000 currently if you're age 50 and over. So in other words, if you're age 50 and over before the end of your taxable year, you can put an additional $1,000 above and beyond the $5,500 that everybody else can contribute. Now keep in mind that $5,500 that limit is shared by both a traditional and Roth. So you can put any variations of amounts to both a traditional and a Roth as long as the combined total of whatever is contributed for the year does not exceed the annual limits that we're looking at. And of course, if a person is age 50 and over, they can put an additional $1,000. Now, other ways to fund a traditional IRA are transfers from other traditional IRAs. You may have traditional IRAs at other financial institutions where you may have contributed to, or maybe you may have rolled over from a previous employer-sponsored plan, such as your 401k plan, a 403b plan, or a governmental 457b plan. Now, keep in mind, it does require a distributable event for under the plan in order for you to be able to roll those assets into an IRA. And here are some of the common triggering events or distributable events. If you quit, whether it be voluntary or involuntary, if you reach normal retirement age, if the plan terminates, in some cases in our society today, if a company closes down and you're working for it, guess what closes down as well? The plan. Therefore, you're allowed to take that money out of the plan and roll it into another tax-deferred account. And that is what we call a traditional IRA. In some cases, there are assets in that account that have been taxed already called a designated Roth account. Those can be rolled into a Roth IRA. Again, direct rollovers from employer-sponsored plans. And another one that's not on the list is that in some cases, if you have small businesses in which some of the attendees to seminars like this are entrepreneurs, contributions to an employer-sponsored plan, as an example, called a SEP plan, a simplified employee pension plan, could be a means of funding your traditional IRA. The reason behind that is that SEP plans are plans that are established by the employer that allows for them to make a contribution on behalf of participants. Now, you may have employees, or you may be the only employee of the plan. You're still allowed to make a contribution. The contributions for SEP plans go into a traditional IRA. Even though some organizations may call it what we call a SEP IRA and traditional IRA are one and the same. It can go into that same traditional IRA. The maximum contribution, by the way, for a SEP plan for 2016 is the smaller of 25% of an employer's compensation, or $53,000. So in other words, if you make $100,000, you can put up to $25,000. Generally, there are some adjustments to that if you're a sole proprietor. We can cover some of these employer-sponsored plans at a future seminar, but we're not going to spend a whole lot of time on that today because we have other topics that, we're trying to focus on the main topic. But if you are interested in that, let us know. We can cover the difference between the different types of employer-sponsored plans. Again, to illustrate how you fund a traditional IRA, it can be annual contributions, it can be transfers from other IRAs, or it can be a direct rollover from a previous employer-sponsored plan, again, such as your 401k plan, a SEP plan, or a simplified or a simple plan, a savings incentive match plan, which is a deferral type of account that contributes the contribution for that plan into a simple IRA, which eventually can be moved to a traditional IRA. For your Roth IRA, annual contributions, as mentioned earlier, is also a means of funding or putting dollars into a Roth IRA. Again, it shares the same limit as a traditional IRA from year to year. Transfers from other Roth IRAs, similar to your traditional IRA, can be a means of funding the Roth IRA. Direct rollovers from employer-sponsored plan designated Roth accounts. There can be a Roth component in an employer-sponsored plan, and those can be rolled into a Roth IRA. And last but not least, you will not find this in a traditional IRA. You can convert, which, by the way, conversions is not a spiritual experience, but it could be. But conversions really is a means of taking assets that have never been taxed before, paying the tax in the year of the conversion, and then putting those dollars into what we call a Roth IRA. What's the benefit for that? Number one, it puts a kibosh on the taxation in the year of conversion because you're paying the tax now to enjoy not only the future growth to be tax deferred, but eventually the earnings or the growth in an investment to be distributed tax-free. Now I'm going to pause here for a second. That's a powerful statement that I just provided to you. Wouldn't you like the fact that in a retirement plan, not only are you allowed to have the growth or the earnings in the account to grow tax deferred, in other words, the growth is not going to get taxed while it's sitting under the umbrella of the retirement plan, but eventually the growth and everything in that account to be distributed tax-free. It's something to ponder on what type of IRA you choose to purchase real estate in. Why is that? Because in comparing the two different types of retirement plans, the taxation of the distribution from these accounts is really something that a lot of people don't pay too much close attention to, but they really should be. Because it's not about how you accumulate the investment, because it's the same for both traditional and Roth IRAs. It's what you get to keep upon the distribution that individuals really need to take a look at. Because if you're going to use it at the time when you retire, would you rather pay tax on that, and depending upon how our tax situation is in the United States, will determine how much you get to keep out of whatever is distributed, or would you rather go ahead and pay the small tax now and never be taxed ever again? And that's why the involvement of a competent tax advisor is essential, because because it does involve taxation and the determination of such sacrifice some IRA holders might want to face today so that they'll never be taxed ever again. Again, that's a powerful statement. Imagine never be taxed ever again. Now let's take a look at the taxation characteristics from these two types of IRAs to offer a fair comparison on whether or not you want to do it in an account that will still be taxed upon distribution or an account that will never be taxed ever again. In a traditional IRA, deductible contributions are taxable. Not only is it taxable if you distribute it prior to attainment of age 59 and a half, as well as if you're not eligible to one of the exemptions to a penalty, not only will the distribution be taxable, it could also be subject to an additional early distribution penalty of 10%. So in other words, if you're in a 25% tax bracket, you will have to fork out to Uncle Sam an approximate amount of 35%. If you're in the 15% tax bracket, imagine taking money out of your IRA and 25% of that goes to Uncle Sam if you're under the age of 59 and a half. Now, non-deductible contributions, in other words, if you've ever made a contribution to a traditional IRA and you couldn't use it as a tax deduction because you were covered by an employer-sponsored plan and you made too much money for that particular year to use your contribution as a tax deduction, the distribution of those non-deductible contributions will not be taxed again, assuming, of course, that you tracked it. The way to track that is using an IRS Form 8606. So if you have traditional IRAs and you've ever made contributions that are called non-deductible contributions, that IRS Form 8606 is used to determine what's taxable and what isn't taxable. So there's a little bit of homework on your part to contact your tax advisor to say, where's my IRS Form 8606, or to locate within your records if an IRS Form 8606 has ever been filed. Now, in a Roth IRA, it works a little bit different. Non-qualified distribution from a Roth IRA, which means that the individual has not satisfied the criteria for everything in the Roth to be tax-free. In other words, you have to jump through hoops in order for everything in the Roth to be tax-free. If it's not, if the criteria has not been satisfied, then it's what we call a non-qualified distribution. In a Roth IRA, since contributions are never used as a tax deduction, contributions can be distributed at any time, penalty-free, tax-free. I'm going to repeat myself again. Contributions in a Roth can be distributed at any time, penalty-free, tax-free. In other words, let's say you've contributed to a Roth $5,000 for every year for 5 years. You have $25,000 of contributions that can be distributed at any time, no tax, no penalty. As you've noticed, that's not how it works in a traditional IRA. Contributions, of course, should be tracked by the IRA holder using what we call an IRS Form 5498 that is issued on a yearly basis by the custodian where they hold their Roth IRA. Now, given the fact that it's not qualified distribution, Roth IRAs follow what we call the ordering rules. The ordering rules means there's a certain set of assets that are automatically viewed to come out first. The first thing that I mentioned are contributions. After the contributions have all been distributed, if anybody has ever done a conversion, meaning that you take money out of a traditional IRA or an employer-sponsored plan and convert that, in other words, pay taxes on it to put it in a Roth, the conversion amount has already been taxed. You can take that money out as a second layer from your Roth IRA. It will never be taxed ever again, but it could be subject to a possible 10% penalty if you haven't held the conversion in Roth IRA for 5 years, or if earlier, attaining age 59 and a half. So in other words, if you convert your assets at age 57, your conversions only have to sit in a Roth IRA for a period of 3 years, an additional 3 years or 2 years, 59 and a half, in order for you to distribute the conversion dollars not only tax-free, but also penalty-free. If it's a non-qualified distribution, how do we deal with the earnings? The earnings are taxed as if they were traditional IRA assets. In other words, subject to tax and a possible penalty. So what's the moral in the statement? wait until your distributions, if you can, wait until the Roth IRA or all of your Roth IRAs has satisfied what we call the qualified distribution criteria. In other words, you must have had any Roth for 5 years. In other words, the moment you contribute to a Roth, the clock starts ticking for all of your Roths for the rest of your life. That's a powerful statement again. If somebody contributes to a Roth, the clock starts ticking for any Roth you establish moving forward. And as a matter of fact, the clock starts ticking as of January 1st of the year for which the contribution is made. Let me give you an example. Let's say you make a contribution to your Roth today, and you've never contributed to any Roth in past years. The clock starts ticking as of January 1st of this year for all of your Roths for the rest of your life. The moment you satisfy the 5-year period, you're only going to be waiting for one of the 4 events in order for you to distribute your earnings tax-free on a Roth. Number 1, if you die, all of your Roth IRAs after 5 years will be tax-free. Number 2, if you become disabled, all of your Roth IRA assets, including earnings, will be taxable, will be non-taxable on behalf of your beneficiaries for the rest of their lives. Number 3, if you attain age 59 and a half and you've had a Roth for 5 years, all of your Roth IRAs are tax-free. That is what we call a qualified distribution out of a Roth IRA. And last but not least, if you're going to distribute up to $10,000 of the earnings to purchase your first-time home, in other words, you're going to distribute it from the Roth IRA to purchase a piece of property outside of an IRA as your first-time home. In other words, you haven't owned your primary residence 2 years prior to the purchase of one, and you have never availed of this provision before, up to $10,000 of the earnings can be distributed, and those earnings will be distributed tax-free as long as you've had a Roth for 5 years. In other words, not only can the contributions be distributed tax and penalty-free, the conversions will also be distributed tax-free and possibly penalty-free, if it's a non-qualified distribution. But if it's qualified, everything in that Roth IRA is tax-free. So it's really important to understand where are you going to accumulate wealth by purchasing a piece of property to be used as a future retirement home in the future. Number 1, again, a traditional IRA will always have taxation because earnings or growth in a traditional IRA grows tax deferred. Another way I explain growth tax deferred is that you're just prolonging your agony. In other words, you're deferring taxation. But eventually, once that growth or earnings is distributed, it will be taxed. In a Roth IRA, eventually, if you play your cards right, in other words, you've had a Roth for 5 years, and you satisfy one of the 4 I mentioned, which, by the way, first-time home is the only one that has a limitation to it. If you die, become disabled, or attain age 59 and a half, and you've had a Roth for 5 years, all of your Roth IRA assets will never be taxed ever again. Again, depending upon the IRA that you choose will determine the taxation upon distribution, which is very strategic in regards to where do you want to build wealth again in purchasing a piece of property to eventually be used as a primary residence for retirement. Now, keep in mind, all growth is tax deferred. It's not taxed while it's sitting under the umbrella of these retirement accounts, but upon distribution, there could be taxation depending upon the type of IRA that you choose. Another thing to put in consideration is it a good time to purchase a piece of property under the retirement plan? Well, of course, historically, when you buy a piece of real estate today, you're hoping that piece of real estate will be valued a whole lot more in the future. In other words, 10 years from now, you're hoping that the piece of property you purchase today is worth a whole lot more. So you have to think to yourself, when I distribute that piece of property out of an IRA, would it be better for me to distribute it out of a traditional IRA, or would it be better for me to distribute it out of a Roth IRA? Keep in mind, if that asset does grow and accumulate, I don't know about you, but I would rather distribute that from an IRA that will never be taxed ever again. If you find your retirement home that you choose to purchase, is it better to purchase it in a traditional or a Roth? I have my own opinion, but I leave that up to you with the assistance of your tax advisor. Now keep in mind, incomes in these particular accounts called rental income from properties that are purchased under a traditional and or a Roth are not taxed while it's sitting under the traditional and or the Roth IRA. Just keep in mind, passive income such as rent is not taxable while it's sitting under the traditional or the Roth IRA. Therefore, the rental income that is received by these properties held under a retirement account can be backed away not only to accumulate wealth under the accounts, but could also be used to pay the future taxation of a piece of real estate, as an example, held under an individual's account. But of course, taxation is a moot point when it comes to in comparing these two different types of retirement accounts. Traditional IRA, again, is taxable upon distribution. Roth IRAs, if you play your cards right, in other words, if it's a qualified distribution, then you can distribute the assets and the earnings not only tax-free, but also penalty-free. Now that we've covered the two different types of accounts, let's review again what a qualified distribution is on a Roth. You must have held a Roth, any Roth, for 5 years. In other words, the moment you make a contribution, whether it be a contribution or a conversion, the contribution will trigger a clock to start as of January 1st. And again, the only thing you'd be waiting for this Roth IRA to be completely tax-free is death, disability, attainment of 59.5, and of course, up to $10,000 of the earnings will be tax-free if you choose to purchase a primary first-time home purchase. Another way to look at this is that in a traditional IRA, distributions are taxable. But again, the rental income that could be derived from renting out the property to somebody else who is what we call a non-disqualified person can be banked away under the retirement account. Now, can it be can the income be transferred to someplace else and not sit in cash? Obviously, yes. You can transfer that to a broker-dealer or another financial institution to bank. You can invest that in a CD and still accumulate tax-deferred in a traditional IRA, another financial institution, or a Roth IRA for the matter, and continue to have that banked away and grow. Now, keep in mind, expenses could also deplete some of the cash that's in a person's IRA. But for the most part, the net proceeds that are in an IRA, of course, less expenses, can be used to accumulate on a tax-deferred basis. It may be used to pay the taxes depending upon the type of IRA you choose to invest in a piece of real estate under. In other words, if it's traditional IRA, it'll defer taxation. But in a Roth IRA, it could be possibly distributed tax-free in the future. So therefore, banking away a lot of that cash is a moot point. Now, there are miscellaneous distribution issues when it comes to IRAs. One of the things is that a common question is, does somebody have to sell the property in order for them to distribute it out of the IRA? The answer is no. There's what we call an in-kind distribution that could be taken, that could be used to take the asset out of an IRA. Now, keep in mind, if it's a piece of real estate, it's typically recorded under the name of the custodian for the benefit of somebody, because in an IRA, the assets are not taxable until you take it out. So therefore, when you take it out, if you're holding a piece of property, it is also retitled at that point. When it's retitled, then it's considered distributed. In other words, you're distributing the property by retitling the property outside of the IRA by titling under your own personal name. And that's what we call an in-kind distribution. Now, what is the taxation of that distribution when it's done in kind? It's the fair market value of the particular asset upon distribution. What does that mean? There may be some additional steps and costs involved in distributing that piece of an investment. In other words, it may be an appraisal that has to take place to report the true fair market valuation of that particular piece of investment upon distribution. In other words, that might be the most prudent way to find out what the value of that piece of property would be that is acceptable to the Internal Revenue Service to determine a taxable amount from a traditional IRA, and also in comparison to that, maybe the amount coming out of the Roth IRA that may be tax-free. But nonetheless, the fair market value is used to report the distribution. The reason why that's important to note as well is because if you're distributing in kind, that fair market value becomes the basis of the property to determine long-term capital gains in the future. Now, in other words, if you held a piece of property for a certain period, you could either be charged short-term capital gains or long-term capital gains. Now, keep in mind, from a tax perspective, depending upon who wins this November for election purposes, could also play a big part in regards to how capital gains is treated moving forward. But currently, right now, if you hold a piece of property for a period of 12 months or more, you will be subject to a tax benefit called the long-term capital gains. But if it's held for a period of 12 months or more or less, well, then you're charged at a short-term capital gains rate, which is taxed at normal taxation. But what is the basis? In other words, what do we determine as a starting point to determine whether or not there's gains on that particular asset upon distribution to the IRA? It's the fair market value of the asset that is distributed or the value of the assets upon distribution in kind. Real estate income produced under an IRA, again, called rents, is not taxable. Again, cash can accumulate at a tax-deferred basis under an IRA, but can be invested in some other types of investments. If you want to invest in a mutual fund, you could do that. You can invest it in a CD under a tax-deferred account. So in other words, the assets or the income that is earned is not only non-taxable while sitting under the IRA, but could also continue to grow tax-deferred. And lastly, as mentioned earlier, the cash that is accumulated under the IRA may be used to offset the tax liability of the distributed real estate once distribution does take place, and if the IRA that's being distributed from is taxable, that can be used to offset the taxation and also the penalty. That is done in the form of what we call withholding. Now, there are typical tax benefits found in a real estate investment not held under an IRA that cannot be availed of real estate-owned investments inside of an IRA. As an example, depreciation. Individuals who own investment property outside of an IRA can use depreciation as a means of saving on an individual's tax return on real estate investments. That is not available if the real piece of real estate is held under an IRA. And lastly, again, additional fees may apply in regards to the yearly valuation of that account to satisfy the government reporting on a yearly basis, as well as upon distribution from a retirement plan. It may be that the custodian could require that an appraisal has to happen so that they can truthfully prove to the IRS that there was a good means of valuing that particular piece of investment that is being distributed out of the IRA, as well as there may be recording fees to retitle that account from the IRA to the IRA holder upon distribution. Now, why do we need to talk about prohibited transactions in an IRA? A common question a lot of people have is that, well, if I'm going to invest in a piece of real estate under an IRA, well, isn't that a prohibited transaction? What does that mean? You cannot benefit out of an investment held under an IRA. As a matter of fact, the definition that the IRS has under the IRS website is that a prohibited transaction is any improper use of an IRA account or annuity by an IRA owner, his or her beneficiary. In other words, beneficiaries could also play a big part in this particular situation, or any disqualified person. Investments in an IRA are intended to benefit the IRA and not the IRA holder directly or indirectly. In other words, although the intent of assets in an IRA is for future use by the IRA holder, while the investment is under the IRA, the benefits, in other words, rental income, or the benefits of a piece of property such as a means of shelter for an individual, is intended to benefit the IRA, not the IRA holder. The IRA holder will benefit from the investment only upon distribution. In other words, any transactions that are done under an IRA must be an arm's length transaction between the IRA holder, disqualified person, beneficiary, and the IRA. Now, here are some examples of prohibited transactions. It's not all inclusive, but it's just here. It's just here to use to give you an illustration of what is considered a prohibited transaction. If a disqualified person uses a property held under an IRA, so in other words, an individual might say, well, can I live in a piece of property while it's sitting in my IRA? The answer is no. Can I work on a property held under an IRA? The answer is no. Can I have a family member live or perform services to the property held by the IRA? The answer is it depends upon which family member we're talking about. Can selling the property under an IRA can I sell the property to a disqualified person? In other words, can I buy that piece of property held under my IRA because I really like that property? The answer is no. Can I lease the property held under an IRA to a disqualified person? In other words, I own an apartment complex. I would like to lease one of the units to my son or daughter. The answer is no. See, in other words, there are certain transactions that are prohibited while an investment is sitting under an IRA, but of course we leave the other recourse of distributing the asset outside of an IRA. That changes the rules a little bit. But while an investment is sitting inside of an IRA, we need to avoid prohibited transactions. Why is that? The ramifications are the IRA will cease to be an IRA as of the first of the calendar year in which that prohibited transaction occurs. So in other words, let's say you have a traditional IRA, and the traditional IRA engages in a prohibited transaction, and the value of the property is $350,000. That $350,000 will no longer be tax deferred. It will be taxable in the year the prohibited transaction occurs, and also possibly subject to an additional 10% early distribution penalty. Just keep in mind, again, traditional IRAs have never been taxed before. Who are disqualified persons? Disqualified persons include, when it comes to family members, are your spouse, your parents, grandparents, your children, your grandchildren, as well as the spouse of any lineal descendant. In other words, the spouses of your children and grandchildren. An IRA fiduciary, in other words, an investment advisor that's actually guiding you through this process, could also be considered a disqualified person. The custodian could be considered as a disqualified person because the custodian of your IRA or trustee of your IRA is the one holding the IRA asset. In other words, there are individuals that could be viewed as a disqualified person. Now, keep in mind, this is not all-inclusive when determining a disqualified person. That's why it is always good or highly advocated or recommended by the Entrust Group to seek out the assistance of a competent tax or legal advisor to determine whether or not a transaction is prohibited or not before proceeding. But at least you know that there are prohibited transactions, as well as there are repercussions involved in engaging in such. Now let's take a look at how take a look at an illustration on how to use your IRA to buy your future retirement home in this particular scenario. We have Jane, who is a researches a qualified realtor. Why is it important to research for a qualified realtor, or basically just engaging with people involved in real estate that is familiar with self-directed accounts? Because there are rules around it. That's the reason why. In this particular example, we're going to use Jane's Roth IRA. Jane has a Roth IRA at another financial institution that she had funded with a conversion from a traditional IRA. She had substantial enough amount of assets in it that she could actually consider purchasing a piece of real estate. In this case, she might even be able to use it for retirement based on the region of the United States that she's in. Now, keep in mind, depending upon the region that you are, the value of real estate could be higher, and some regions, the value of a piece of real estate may be lower. In other words, it might be not so expensive. In some places, it's more expensive. Jane started interviewing realtors to see if they have understanding of self-directed IRAs. You keep in mind, the title of the investment must be held under the name of the retirement plan in order for Jane not to get taxed on it. Jane researches a qualified realtor. She also went through the vetting process of finding title companies that understand self-directed IRAs, because the title company must also understand that it's the IRA that's purchasing the piece of real estate and not Jane personally. Jane needs to, the title company also needs to understand that items such as the earnest money should come from the IRA and not Jane. The title of the property, as mentioned earlier, should also be under the IRA's name. Here's an example. The Entrust group for the benefit of Jane's IRA and the account number to make sure that it's clear that it's a particular IRA under the custodian or trustee that's actually being used to purchase the particular investment, in this case, a piece of real estate. In this process, we're just using the Entrust group. This could be done in any custodian or trustee, but we're just using the Entrust group since we're the ones sponsoring the event. Jane establishes an Entrust account, in this case a Roth IRA. Jane funds the account via transfer from another Roth IRA. It could also be a contribution, a direct rollover from an employer-sponsored plan called a conversion, or designated Roth accounts mentioned in previous slides. But in this case, she's transferring from another Roth IRA to another financial institution. The next step is Jane researches for a property she would like to purchase. Now that the account is funded, she's itching to buy a piece of property. Jane works with a realtor that's knowledgeable about this process. Jane finds a promising property to invest in. Jane, after Jane completes her due diligence, in other words, completes inspections, all the necessary things, are there any covenants to the property, et cetera, then Jane makes an all-cash offer for the property. In this case, the property is worth $200,000 for illustration purposes. Jane makes an all-cash offer of $200,000, of course, in the name of her Roth IRA, because Jane is the IRA holder, but it's the Roth IRA that's actually purchasing the piece of property. Jane also instructs her custodian, in this case, the Entrust group, to send an amount for the earnest money. The earnest money has to come from the IRA, because it's the IRA that's purchasing the piece of real estate, although Jane is directing all the transactions that are going on. That's where we get the term self-directed. Jane, in this case, has to instruct the Entrust group on what her wishes are. And, of course, most custodians and trustees would require that instruction in writing. In our financial organization, we call that letter called the bidirection letter. In other words, Jane directs us as the custodian to purchase that piece of property, in writing, of course. The good faith deposit of $20,000 is processed through the Entrust group. A purchase contract must be also titled in the name of the IRA. The title company prepares the documents. All documents are signed, read, and approved by Jane, because keep in mind, Jane is the one instructing and facilitating this process. Signatures required on the closing documents are executed by the Entrust group, in other words, the custodian or the trustee. Why is that? Because it's the IRA that's purchasing the investment. The Entrust group is part of the title of the piece of property purchased by Jane's IRA, in this case a Roth IRA, and voila, the property is purchased. Entrust group sends and signed completed documents to the title and escrow. The Entrust group wires the remaining $180,000 to fund the purchase and closes the transaction to the title company. What I've found is that in some transactions that I've been involved in, the transaction works a lot quicker. Why is that? Because we don't have a lending institution that's involved. Because if cash is there, purchasing a piece of property could be a lot quicker, which therefore could provide better bargaining power in regards to the purchase price of a piece of property. In this case, the deal is closed. The purchase is complete. The title or vesting of the property is under Jane's IRA. Now, there are miscellaneous operating issues. Given the fact that most pieces of real estate that are purchased under the IRA or real properties purchased under an IRA has not only income but also expenses. In other words, income must be paid to the IRA if you have renters. Some individuals may hire also an external property manager that basically sends and remits the income to the custodian, because it can never go back to the IRA holder directly. Because keep in mind, in a tax-deferred account, gains and losses are suppressed. In other words, it all happens under an IRA without reporting to the Internal Revenue Service. Therefore, all incomes must go into the IRA, and also all expenses must be paid out of the IRA. Here are some examples of expenses: property taxes, insurance, homeowners association for the piece of property. Those are just examples of expenses. But revenue, such as rental income, must be deposited back into the IRA. And given the fact that there are a lot of things that the IRA holder cannot do on behalf of the property, or else it's considered a prohibited transaction, it is highly recommended that an external property manager, or in other words, an arm's length property manager, to be hired to facilitate all the processes or the maintenance or the oversight of the property to be given as a responsibility of another party. Of course, there are fees also that are typically associated with hiring a property manager. Now, in our example, 7 years later, Jane takes the property as a distribution. Now, in this case, it's a Roth IRA. Jane would like to use the property held under her Roth IRA to live in during retirement. Jane has had a Roth IRA for 7 years, which she satisfies the 5-year rule. In this case, Jane is 61 years old, which satisfies the age requirement for the qualified distribution on a Roth. Jane distributes the property tax and penalty-free. In other words, Jane was able to accumulate wealth under her retirement plan. In this case, purchase a piece of property, locking in on a price 7 years prior, and when she distributes the piece of property, understanding the rule means that the property is distributed tax-free. In other words, $200,000 piece of property, let's say now it's worth $350,000. Basically, she was able to distribute the $150,000 gain on that property tax-free out of her Roth IRA. Now, again, here's another revisit of that. In a traditional IRA, assets grow tax-deferred. Cash income is not taxable, so you can build wealth under an IRA to use for future taxation. I hope that you've built enough wealth to be able to pay the tax liability, because who knows what the tax liability is in the future. But in a Roth IRA, given the fact that contributions have been taxed already, and if the qualified distribution criteria is satisfied, everything in that Roth will be distributed tax-free. Now, in summary, Roth IRAs are funded with after-tax contributions. Traditional IRAs are funded with pre-tax contributions, and as well as the earning, typically pre-tax, as well as the earnings grow tax-deferred. In other words, those assets have never been taxed before. Earnings or growth may be tax-free if a Roth IRA holder holds the Roth for a period of 5 years and have attained one of the following: age 59 and a half, dies, or becomes disabled. One of the things we learned is that you cannot use the property for personal use while it's in your IRA, but nothing prohibits you to distribute the piece of property in the future. You have different options to distribute the property in your IRA. You can either distribute it in cash, in other words, the property can be sold, and then cash proceeds will be distributed. But if you do like that property, nothing prohibits you from distributing that piece of property in kind. The fair market value of that property will be reported as the amount coming out of that IRA. It could be taxable, or in some cases non-taxable in the event of an example, a Roth IRA. Again, my name is John Paul Ruiz, the Director of Professional Development here at the Entrust Group. I hope that you found this particular presentation to be meaningful and answered your questions. We look forward to having you again in a future Entrust Group national webinar. Again, my name is John Paul Ruiz. I thank you and hope to have you again in another future Entrust Group seminar. Thank you and have a great day.